Hello, everyone. Welcome to our June session of the Secure 2.0 Deep Dive series. Today, we are going to rethink matching contributions. This is the glamorous topic that made the national news. Everyone was talking about it. If any provision was the water cooler provision of Secure 2.0, this is the one. So we're happy to dive right in. I'm Michael Durnwald, your host for this series and an attorney in our employee benefits practice here at Thompson Hine. But I will start with a couple administrative notes. The first is you will get a copy of today's slides and the recorded session. It can take 1 to 2 business days after the webinar to get those, but you will get those. And then if you're interested in asking a question today, look at the upper right-hand corner of your screen, and that's how you can answer a question. And earlier today, Ed was telling me he loves questions, so feel free to share those with us all. So let's introduce Ed. There he is. We can all look at him. Ed is a partner in our Columbus office, and he has years of experience both at a law firm and also at a financial services company, advising them on their retirement plan services. So he sort of understands retirement plans from multiple angles, and so he's a great person to touch on this topic. And you'll note he's yet a third speaker in our series that we've had so far, and that's one of the things that we pride ourselves on here at Thompson Hine is the depth and breadth of our bench when it comes to employee benefits. And so without further ado, I will turn it over to Ed.
Thanks so much, Michael. And I do have to say, I wish I still looked at like my picture that was just up on the last slide. Anybody that knows me and sees me often knows that I don't anymore. So thank you for including that picture. And it's a pleasure to be with everybody today. As Michael noted, this is a fun topic, I think, under Secure 2.0. There's a lot of moving parts to Secure 2.0, but certainly this is one that's gotten a lot of press and a lot of attention. And so today, again, we're going to devote our discussion of Section 110 of Secure 2.0, which addresses and deals with matching contributions on student loan repayments. But let's just step back for a second and revisit Secure 2.0 generally, right? Remember, it was signed into law late last year as part of the Consolidated Appropriations Act and is intended to, has these primary goals: increase access to employer-sponsored retirement plans, ease the regulatory burdens of sponsoring retirement plans, and educate Americans about retirement plans and saving for retirement. And so really Section 110 focuses on the first, increasing access to employer-sponsored retirement plans. Let's move to the next slide. So let's talk about why. Like, why is this an important topic? Why did Congress decide to address this in Secure 2.0? Well, as we all know, we all hear in the news constantly, we're bombarded by the fact that student loan indebtedness is a real problem, and it's really exploded in recent decades. So accounting for inflation, over the last 30 years, tuition and fees for public four-year colleges have increased 124.6%, and fees for private four-year colleges have increased by 80.2%, which is really dramatic. And I have to say, you know, I'm in my 50s, and when I went to college, it seemed expensive. And I guess I just kind of set aside and assumed that, yeah, it's roughly the same as it was back then. And, you know, it increased for inflation, but this really tells a different story, that it's a significantly greater burden now for current generations than it was when I went to school, for instance. The percentage of households with student loans more than doubled between 1992 and 2019. So not only has the burden increased, right? It's broader. It's affecting more of the population. More than 43 million Americans have student loan debt, totaling more than $1.78 trillion, with the average loan in 2023 being more than $37,000. So we could restate all sorts of statistics, but the bottom line is this is a significant issue. It's a significant burden on folks attending college, both getting a degree and not getting a degree, and arguably even more impactful for those that don't finish their degree. And at the same time, right, federal support has not kept up with the cost of inflation. For instance, Pell Grants, used to cover nearly 80% of the cost of a 4-year public college degree, and now only cover about 1/3 of the cost. So not only have the costs gone up, but government support of students has gone down at the same time.
And then Ed, I have a couple of additional statistics to give some context to the numbers we see on this slide. First, that 43 million Americans, that's almost 20% of Americans that have student loan debt. And then for that 1.78 trillion, if you break that down into age bands, this sort of surprised me, but it's actually 35 to 49-year-olds that carry the largest amount of that debt, followed by the 25 to 35-year-olds, which is more what I expected, but it's actually older population than you would think that's carried most of that debt. And then for the average student loan debt, that 37,000, it really depends on the degree. So if you, for instance, are an employer that's hiring a bunch of undergrads, their average debt burden is about 28,000. So that's lower. But then if you're, say, a consulting firm hiring a bunch of MBA graduates, they're at 66,000 average student loan debt. If you're a law firm hiring a bunch of newly minted JDs, they have an average of 130,000 debt. And if you're a health system hiring people with medical degrees, that's over $203,000 per individual. So it definitely varies, but if you're hiring people with higher education, graduate education, their student loan debt's even higher.
No, those are great additions, Michael, and thank you for adding that. I would also say too, remember, right? It's not only our younger employees who just went through college degree themselves. Think about your employees who are reaching an age where their children are now going off to school and potentially incurring debt. So it's not only a burden on the student necessarily, but also a burden on the families overall. And so I want to stop here too and think about this, right? So we've talked about the burden of student loans on much of our workforce, but let's also look at it from the perspective of retirement savings. We all know, and we hear over and over and over again, right? There's been this shift from defined benefit plans to defined contribution plans, right? So shifting more of the burden on individuals to save in a retirement plan. We also hear that Social Security benefits are at risk at this point. I think I just saw in the paper a couple days ago. Right now the trust fund is projected to be depleted by 2033, which is, it seems like it keeps creeping closer and closer, right, and getting earlier and earlier when they adjust those deadlines. And so, who knows what's going to happen with that in this political environment, whether there will be changes to support Social Security moving forward. But the bottom line is, more and more of the burden for saving for retirement has been imposed on individuals rather than on the employer or on the government with Social Security benefits. And so it makes it critical, right, for folks to be able to save for retirement. And so you have this combination, this kind of perfect storm of people's ability to save for retirement declining, partially because of student loan debt, while more of the burden being shifted to them to save. And so I found these statistics to be really interesting. So the impact is most pronounced for workers starting out and workers helping their children fund college, as I mentioned. For young families, i.e. those with heads of household younger than 35 with college degrees, average 401k account balances were significantly lower for those with student loan debt. I mean, the numbers are dramatic. If you have student loan debt, the ability to save, or the savings that people have actually done, is much lower than those without student loan debt, which is intuitive, right? It makes a lot of logical sense, but boy, seeing those numbers really is dramatic.
And then add just a couple more comments on these statistics. So talking about workers coming out of college, 55% of graduates coming out of school have student loan debt. So you can keep that basically half of your population if they have a college degree has student debt. And then when it comes to parents, the average balance that a parent takes for a child in college is $29,000 in parent plus loans. So that's just one particular type of federal loan. That doesn't include any private loans that parents take out. So even, if your parents, employees don't have a college education, they might have children that they're funding. So the student debt of your employee population might be more than you think it is. So.
Absolutely. And so what do we do about this, right? So there's a variety of remedies out there and being considered for student loan debt, right? We have President Biden's student loan forgiveness program, which the Supreme Court ought to be weighing in any day now, right, Michael?
Right. Yeah. Typically, they issue all their opinions by the last week of June. We're Wednesday in the last week of June. Opinions are scheduled for tomorrow. There's 7 opinions left. So either tomorrow or they'll probably schedule a second day when they issue opinions. And so we should know either tomorrow or whatever day they schedule, whether it's Friday or they actually go into next week.
Right. We also have income contingent repayment options. Most recently, there was an act introduced in the Senate, the Lowering Education Costs and Debt Act. I looked at the highlights of the proposal. It really is largely designed to provide additional information and education to borrowers, right? We all see this kind of in the 401k setting, right? We've all witnessed this with additional disclosures helping to drive down costs. And I think that's really the rationale behind much of or many of the provisions in this act. And so time will tell, right? We just don't know how impactful those remedies may be. And to the extent they are very successful and taken up, then they very well may impact an employer's decision on whether to match student loan payments and add this feature. Yeah, and so this is not a new structure or concept. So some employers have been creative in designing qualified plans in the past, right, to provide certain employer contributions on account of student loan payments. But from my experience, anecdotally, of course, I just haven't seen many employers take up these sorts of options at this point. But let's talk about the guidance that really kind of started this discussion on a broader basis. So in August of 2018, Abbott Labs received a private letter ruling really addressing just one issue, and whether its proposed design to make employer contributions on account of student loan repayments would violate the contingent benefit rule. So the proposed structure, so the proposal was to add a 5% non-elective contribution for participants who committed at least 2% of their compensation to repay student loans. And if participants were eligible for the non-elective contribution, they were not eligible for the matching contribution available in the plan. And so really the question posed and responded to in the letter was whether it violated the contingent benefit rule. And the IRS said, no, it doesn't, because the payments were not conditioned on the employee making or not making contributions to the plan, right? When you make student loan repayments, they're going to your lender and not the plan. And so the IRS ruled that no, that does not violate the contingent benefit rule. But they only focused on that particular issue. They didn't address any other qualification requirements that could be implicated, including non-discrimination testing. And so from my perspective, and Michael, you may have a different perspective, but the PLR was helpful, right? But its impact is limited, or has been limited. Only the taxpayer receiving the PLR can rely on the PLR. And it only addressed the contingent benefit rule and left open a variety of other questions that employers had to deal with in collaboration with their third-party administrators or record keepers. And so, again, I can't speak for every practitioner, but the response to this was pretty muted. I mean, employers talked about it, they kicked it around, and I think some did adopt it, but I can tell you none of my clients adopted this sort of program.
And then Ed, can you just explain what a private letter ruling is, just to help kind of put some context to this?
Yeah, it's a ruling really on a particular tax issue, right? That a taxpayer can seek from the Internal Revenue Service, right? And it only is binding on that particular taxpayer. So while we have this helpful guidance, and certainly it's supportive that the service would agree to an identical structure potentially, it's not binding. It's only binding on that particular taxpayer. And so we just didn't have any other broader guidance or guidance of broader applicability to rely on. And so that's why, you know, it's interesting, and conceptually it's very helpful because it kind of gets into the minds of the service on a proposed structure, but really it's limited to that taxpayer. And so now, though, fast forward to December 29th of last year, and now we have Secure 2.0 in Section 110. So I want to take a little bit of time just to walk through the basics. Many of you may have already heard about these basics, but I think it's worth hitting on again. So first of all, the provisions effective for contributions made for plan years beginning after December 31st, 2023. So it's just important to note, right? Matching contributions made in 2024 for the 2023 plan year are not eligible for treatment under Section 110. So if you match on a plan year basis and you're matching in 2024 for 2023, just remember those would not be subject to Secure 2.0 Section 110. It's also important to remember it's optional. So there are a number of mandatory provisions in Secure 2.0. This is not one of them. So employers truly can decide whether they wish to put this in place in future years. And certainly, as just a foreshadow, it's likely going to be a wait and see approach based on guidance. And we should also note that it's available for plans under Code Sections 401K, 403B, 408P, and governmental 457B plans.
And then just in case anybody's sitting there going, what the heck is a 408P plan, if you've never heard of it, that is a small employer plan called a simple IRA plan. So just in case you didn't know that.
Yeah, thanks, Michael. And so what are the basic requirements for having an employer match program on student loan repayments? So an employer contribution made to an eligible plan is treated as a matching contribution if you meet all of these requirements. So first of all, the contribution is made on account of qualified student loan payment. And in a few slides, we're going to get into just what that is, because there are a variety of references in the statute that you have to kind of work through to get to what a Q-slip is. And I will refer to it as a Q-slip from this point forward. And then the plan provides for matching contributions on elective deferrals at the same rate as contributions on account of Q-slips, right? And so we really have to treat them the same. If we're matching on elective contributions, we have to match at the same rate on Q-slips. Matching, going back, there we go. Matching contributions are made only on behalf of employees otherwise eligible to receive matching contributions on account of elective deferrals. So in other words, folks have to be eligible to receive the Q-slips. They have to be eligible to receive matching on account of elective deferrals. And then similarly, all employees eligible to receive matching contributions on account of elective deferrals must be eligible to receive matching contributions on account of Q-slips, right? So these requirements are really designed so that it's kind of a consistent approach to your match, right? And so you can't slice and dice the population from that perspective and say, well, you're eligible for Q-slips, but not for match on elective deferrals. And then the plan provides that matching contributions on account of Q-slips vest in the same manner as matching contributions on account of elective deferrals. And then just a simple example we have in the next slide. So So let's assume employer X sponsors a 401k plan. It provides for a fixed 100% match on up to 3% of plan compensation deferred to the plan and allocates matching contributions on a payroll basis. Effective for plan year beginning January 1st, 2024, employer X decides to implement matching contributions on Q-slips and provides that all employees otherwise eligible for match on deferrals may receive the same level of match on Q-slips, and all matching contributions are immediately 100% vested. Well, that's a design that certainly would meet the requirements as we tick through, right? Because it provides for matching contributions on Q-slips at the same rate as deferrals. The matching contributions on Q-slips are only made to individuals otherwise eligible for the match, and all employees eligible for matching contributions on deferrals are eligible for matching contributions on Q-slips, and they vest in the same way. So we've kind of ticked through the basic requirements, setting aside, the big issue of what the heck is a Q-slip for a moment. But this basic structure would satisfy the requirements of Section 110 to be treated as matching contributions. But that was the easy part, right? So we have this design, but then we adopt this design and we start working through implementation issues, and because we all know devil's in the details, right, with benefits. So employer X starts to implement administrative procedures for the new feature and realizes matching Q-slips on a payroll basis will be a nightmare, right? And so how are you going to do that? Most student loan payments are made on a monthly basis, not on a payroll basis. So how are you going to allocate on a payroll basis? How and when can an employee claim the match on Q-slips? So again, would somebody have to certify for each payroll period that they made student loan repayments? It just is an administrative nightmare if you have to do this 100% the same way for matching on elective deferrals and matching on Q-slips. Think about the administrative burden of trying to collect certifications on a basis more often than on an annual basis, and that in and of itself is an administrative burden, but that would just be very daunting and certainly put a chilling effect, I think, on folks or employers' uptake of these sorts of programs. So recognizing a lot of these kind of practical issues and questions raised, Treasury is directed to prescribe regulations, right, implementing the provisions. One of which is to permit a plan to match Q-slips on a different frequency than other matching contributions, but it has to be at least annually. So in my earlier example, right, we could match elective deferrals on a payroll basis and match Q-slips on an annual basis. Now, we'll have to wait and see what sort of details are in the regulations that permit that, whether there are strings attached to that, which I'm sure there will be, but that's welcome guidance, because again, it would be a nightmare to try to do it any other way. And then also permit adoption of reasonable procedures to claim matching contributions on Q-slips, which may include an annual deadline that is no earlier than 3 months after the close of the applicable plan year. And we'll get into this more later when we talk about non-discrimination testing, but that's an interesting provision and may cause some practical headaches, unless there's some other relief provided by the IRS. And then finally, they were directed to provide model amendments to adopt the feature.
And just a comment on these Treasury regulations that are supposed to be issued. Every 6 months, both the Treasury and the Department of Labor issue what's called their regulatory priorities, and it basically just lists all the rules of different regulations are supposed to issue. Even though this provision is going to affect January 1st, 2024, the IRS did not add regulations under the student loan match to their list, even as sort of like a pre-preliminary rule. So, I mean, obviously it's reading tea leaves, but I don't suspect we're going to get these regulations before this provision takes effect.
Yeah, and maybe, Michael, that's not entirely surprising, right? Since there's so many IRS has a lot of irons in the fire, right? There are mandatory provisions of Secure 2.0. There are still provisions and guidance we're awaiting on Secure 1.0. So, boy, when I guess you're prioritizing, right? Should we prioritize issuing guidance on an optional provision? Yeah, it kind of makes some sense. It's unfortunate, but it kind of makes some sense. So let's talk about what a Q-slip is. It's a payment made by an employee in repayment of a qualified education loan, as defined in IRC section 221D1, but only to the extent that the payments in the aggregate for the year do not exceed the IRC section 402G limit for the year, or if it's less, the section 415 compensation of the employee, less elective deferrals made by the employee for such year. So this is not an end run around, the limits, the 402G limits on elective deferrals in a given year, and so we do have to account for the combined limit on both the student loan repayments and elective deferrals from that perspective. And another requirement to be a Q-slip is that the employee has to certify annually to the employer that such payment has been made on such loan.
Ed, do you happen to have the 402G limit for this year memorized?
Yeah, it's 22,500, and if you're catch-up eligible, I guess you're all the way up to 30.
Okay, yeah, that just gives some color to that.
Yeah. And so now we've defined a definition, but we have to define a definition within that definition, and that is a qualified education loan. How is that defined? So it's any indebtedness incurred by the taxpayer solely to pay qualified higher education expenses that, one, are incurred on behalf of the taxpayer, the spouse, or dependent of the taxpayer, as of the time the indebtedness was incurred, are paid or incurred within a reasonable time before or after the indebtedness is incurred, and are attributable to education furnished during a period during which the recipient was an eligible student. And it includes indebtedness used to refinance indebtedness that qualifies as a qualified education expense. So there's a lot there, and I've seen a lot of commentary and questions about, okay, well, does this only cover the student loan debt of the employee themselves? This seems to indicate otherwise, right? That it could be student loan debt that's been incurred by the taxpayer, but for a third party, much like my example or my note earlier in the presentation, that there's significant burden on not only some of our younger employees, but some of our employees with children who are college age and facing student loan debt. So I think there's some expectation that there will be further refinement, further clarification of exactly what is covered under this. But boy, it does seem, at this point anyhow, reading through the definitions, that it would be more expansive than just the employee only, at least from a definitional standpoint.
Yeah, and then Ed, we had a question on that point about what if an employee is a parent and they're paying their child's student loan repayment. So just to hammer it home, I would say, if you look at that first dash where it can be an expense that your dependent incurred for qualified education expenses, we're thinking that likely that person would qualify for the match. Would you agree with that?
Yeah, I think so, Michael. There may be some nuance there, right? Is it indebtedness incurred by the taxpayer? So for instance, is the parent just voluntarily helping their student or their son or daughter, right, pay off student loan debt? Or was it a loan taken out by mom or dad to assist with or to pay for student loan indebtedness? I think that could be a turning point or a decisional point on that question. And then again, we have another definition within a definition. A higher education expense is defined. And I love this reference. The cost of attendance under the Higher Education Act of 1965, as in effect immediately before enactment of the Taxpayer Relief Act of 1997. So long story short, it generally includes tuition and fees, books, supplies, and transportation within certain limits, and room and board within certain limitations. So things that you would ordinarily think about. Though, again, I think it's going to be very difficult if you're an employer trying to figure out, or if you had to figure out whether these truly were Q slips, whether they were for higher education expenses. There's a lot there, and again, that's likely why Congress said, boy, employer, you can just rely on the certification of your employee. So let's turn to some other important aspects of this, and as you might expect, this could have non-discrimination testing implications. And if you think through it, we'll kind of try to tease out some of those implications in the next few slides. It really could. Absent relief, addition of matching contributions on Q slips could raise a variety of potential coverage and non-discrimination issues. So think about it. If you put this in place, you have a lot of employees. Yes, on the face of the plan, they're eligible for match on student loan repayments, but the practical reality is that 95% of them don't have student loan debt, right? You would say, oh, that could be problematic, right? That could be mean that this is not currently available to those individuals who don't have qualified student loans. So there could be, again, coverage and non-discrimination implications of that. And it could also impact ADP testing, right? And you say, well, hold on a second, I thought we were talking about match, not elective deferrals. But if you think about it conceptually, it's going to have an impact on ADP testing. Under Secure 2.0, Q slips are not treated as elective deferrals for ADP testing. And so one example is that if an NHCE allocates their resources to paying student loans and decreases their elective deferrals to do so, it could lower the average ADP percentage, right, for the NHCEs, and of course, by implication, potentially put downward pressure on the amount that HCEs in the plan could defer to the plan.
And then Ed, just to level set in case anybody doesn't understand what ADP testing is, can you just quickly explain what that's looking at?
Yeah, and I should also back up too, and my apologies. I fall into that trap of assuming that everybody knows the acronyms that we're using. So that's my issue. An HCE is a highly compensated employee, and an NHCE is a non-highly compensated employee. And under the rules for 401k plans, when we're looking at deferrals, the code puts in place restrictions on kind of the differential between the amounts that non-highly compensated employees contribute to the plan and highly compensated employees contribute to the plan. And so you have to fall within certain corridors for the plan to pass testing, right? And so that's what the ADP test looks at. It compares the average deferral percentage of non-highly compensated employees to those of highly compensated employees. And there's some numerical tests that apply, but bottom line is you have to perform this each year unless you're a safe harbor plan. And if you fail, then corrective action needs to be taken. So let's talk about the relief under 401A4 and 410B. That provides that matching contributions on Q slips will not fail to be treated as available solely because the participant does not have qualified education loans. And again, we've already touched on this once, or I've already discussed it. It could have implications because we could have significant portions of our employee population that simply don't have qualified education loans. And if we took a harder line approach to this or view, one could argue, well, they're really not eligible for those the matching contributions on student loan repayments because they simply don't have student loans to match. And so there could certainly be some implications. So this is welcome relief on 401A4 and 410B, which cover the general non-discrimination, benefits, rights, and features testing and coverage testing under 410B. And let's talk a little bit more about the relief under the ADP testing, right? Again, the test for elective deferrals. So Secure 2.0 says or provides that a plan may disaggregate and test separately the population that receives matching contributions on Q slips. And so again, why is that important? So if we have a lot of individuals within a company, right, that's participating in a 401k plan, if they have a lot of student loans and have been making elective deferrals to the plan, they very well may shift their behavior and say, boy, I can not contribute. I can simply certify to my repayment of my student loans and receive the full match. And by implication, potentially reduce their deferrals. So again, that could potentially have an adverse impact on HCEs by potentially lowering their average ADP of non-highly compensated employees. Because remember, we're comparing those average deferral percentages of the non-highly compensated employees and the highly compensated employees. And so if that average ADP of the NHCEs goes down, it could put downward pressure on the HCEs. And so by disaggregating, the individuals who lower their deferral percentages, which again, not universally, but likely will include or disproportionately include non-highly compensated employees, it could pull lower deferral percentages, including zeros from the ADP test for those not making Q slips. So it's really a nice benefit designed to kind of offset some of the potential behavioral changes of the workforce, so that we're not at least penalizing the group that's not making student loan repayments. So it's a little bit quirky though, and so this slide is really just an example of, boy, the devil's in the details, and you have to really work through the potential implications of testing and how it could impact different populations, right? And so my statement is HCEs likely should make elective deferrals or receive match on Q slips, but not both. And so I have just a quick example to run through. So let's say the plan matches 100% on up to 5% of compensation deferred to the plan, and an employer adds match on Q slips at the same rate, but an HCE defers 4% and decides to claim match on Q slips equal to 1%. So in that situation, if the plan disaggregates for ADP testing, right, all participants who receive Q slips must be tested separately. This will result in the HCE's deferrals being tested with a Q slip group, which will likely have a lower average NHCE ADP, right? Because again, we suspect that, or expect that NHCEs who have student loan debt very well may lower their deferral percentages if they're deferring at this point in time, and shift some of those dollars to repaying their student loans and certify to the plan that they've repaid those loans or made payments on those loans and qualify for the match. So again, it could shove this HCE into this group with folks who are disaggregated because they're making Q slips. Now, on the flip side, though, we have to remember, again, a lot of this is going to depend on your demographics. I mean, you could have a small group. Let's say you have a dental practice, right, that has 3 dentists and you have seven staff members, and none of the staff members have student loans, but the dentists all have student loans from going to dental school, which I've heard is expensive. And so in that circumstance, it could lead to some interesting results, right? So if you have the HCEs repay their student loans and certify to it and receive match, and you disaggregate, you'd be testing just your HCEs. So only HCEs would be in that disaggregated group. And so actually it could be beneficial to that group. So long and the short of it is, I think you really have to think about the type of employer you are, the demographics of the employer, how this is likely to impact your workforce, and how many folks are actually going to take part in this type of program, and really run through the scenarios and do some projections. And we should not forget safe harbor plans, right? So just again, as background quickly, a safe harbor plan is one that has a specific design and I've restated the basic the traditional safe harbor match formula for a safe harbor plan, right? It's you match 100% on the first 3% of planned compensation that's deferred, and then 50% on the next 2% of planned compensation deferred. And so by doing so, and if that's the only match you make, right, or within certain constraints, you can automatically satisfy the ADP test, meaning you don't have to actually run the test and the ACP test. And so it's important to think about safe harbor plans as well. So under the current safe harbor rules, though, a plan must match only on elective deferrals within specified parameters. So it doesn't say anything about student loan repayments, but the statute, they considered that, right? And they put in a feature to address that issue. And it says, for purposes of satisfying the traditional and QACA safe harbors, a plan may treat Q-slips as elective deferrals. And so that gets us there. That allows us to have this feature in a safe harbor plan and still rely on the safe harbor.
And then Ed, can you start the slide with the quick explanation of ACP?
Yeah, so ACP testing is very similar to ADP testing, though it's testing matching contributions and after-tax contributions rather than elective deferrals. And when I say after-tax, I'm not talking about Roth. I'm actually talking about true voluntary after-tax contributions to the plan. And so, again, it compares the percentages, right, of the highly compensated employees and non-highly compensated employees, and kind of depending on the outcome, if you satisfy the test, then you're fine. If you don't, there could be corrections necessary. And so this may surprise some people until you start thinking kind of through the potential impact, right? There's no special testing rule that's available for ACP testing. So the non-discrimination testing applicable to match and contributions and employer after-tax contributions just operates as it ordinarily would. But if you step back, realistically, the ACP testing results should improve, or at least not be any worse than they were before the change. So we actually may be improving, and let's talk through that, right? So again, let's say we have an employer with 10,000 employees, 5,000 employees are participating currently, and there's a deferral option and matching on those deferrals. So we put in this match on student loan repayments, and let's say we attract an additional 1,000 employees, right? That really don't have to do anything differently than they are currently, right? All they have to do is certify to the plan that they're making student loan repayments. So if we add that 1,000 to the plan, right, it's going to help because their matching percentages are going to be added to the test. And so it actually should improve the results of the ACP testing. So kind of an interesting feature, interesting result, but truly this sort of feature actually ought to help a plan improve its ACP testing results. So let's devil's always in the details again, as I've already said, but there are a number of open questions, right? So first one, Q-slips and certification. So first question is, can an employer limit what types of Q-slips qualify for matching contributions, right? So we talked about the various student loans that could potentially count as Q-slips, but does an employer have to provide match on all types of Q-slips or any loan repayments that would be considered a Q-slip? Or could it decide, hey, we're going to target this. We're really trying to enhance the benefit to our younger employees who come out of school with student loan debt. And so we're just going to focus on those employees with their own personal education expenses. And I think that's an open question. I don't think there's a clear answer on that at this point. Hopefully we'll get guidance on that point, but so that's one open question. And then second, while an employer may rely on a participant's certification of repayment and actually has to get a certification, could the employer impose additional substantiation requirements of student loan qualification and payment? So, all of a sudden you put this into place and another 5,000 employees all of a sudden have student loans and start certifying to their student loan repayments. Well, it's not a stretch to think that an employer may want to impose additional requirements, additional substantiation requirements on those repayments. Because, again, there's a cost attached to this, right? If you're making more match, you're making more match as an employer. And that's additional dollars that have to go into the plan. So we'll have to wait and see whether we get guidance on that point or not. Yeah, so also this directive, right, that we see in Secure 2.0 to Treasury, suggests that match on Q-slips may be made on a different frequency than other matching contributions. So, but that raises some questions as well. And so let's assume, in my earlier example, we have a payroll match. Matches on deferrals are made on a payroll basis. And we've decided, hey, we've got this great guidance. We can match Q-slips on an annual basis. So what's interesting is, would a plan be required to provide true-up matching contributions for deferral-based matching contributions? Because if you look at the two, right, we know that people could come in and out of making elective deferrals, may not qualify for the full match on a payroll basis if we were to match on a full year basis. And so if we're matching on the Q-slips on an annual basis, well, we have to go in and put in a true-up matching contribution feature. Just don't know. So hopefully we'll get details on those sorts of questions. The other really puzzling piece to this too is the directive to Treasury that eligible employees must be given at least 3 months following the end of the plan year to submit claims for match. So in other words, plan year ends, 3 months, at least 3 months have to run to allow folks to claim the match on student loan repayments. Well, what do we know happens before the end of that 3 months? Well, March 15th rolls around, and generally employers target completing their ACP and ADP testing and making any corrections to happen before March 15th, because otherwise there could be excise tax implications to going beyond that if there are failures. And so now we're in this strange position. We put in this student loan repayment match, but we have to wait until really after that deadline to avoid excise taxes to complete our testing. And so again, will there be any relief from excise taxes if a plan decides to implement this sort of program? I would hope so. I would think that the service is going to think through that and give some relief, but it really is an open question at this point. Disaggregation, I expect that an employer could test the plan both ways and see how the results turn out. But could there be strings on that? Could there be requirements to designate or to make a formal election to test on a disaggregated basis? Again, I don't think so, but we'll have to see if there's guidance on that particular point. And could an employer exclude bargain employees from matching contributions on Q-slips? If bargain employees can receive matching contributions on deferrals, and also kind of similarly, what about HCEs, right? We can generally carve out and discriminate against HCEs. But with a collectively bargain group, right, we're governed by the terms of a CBA, right? And if our CBA is in place and it provides, for a certain level of benefits, can we just put this in place and carve out the bargain employees until the next CBA is adopted? So I just think there are a number of questions on whether we can. I know that the statute seems clear that, boy, everybody needs to be, if you're receiving elective deferrals, or match on elective deferrals, you also have to be eligible for match on Q-slips. But could there be some relief, some guidance that suggests that, yes, for certain groups, you could carve them out? And so let's talk about some employer considerations. So, first of all, is this important to your workforce? Do you have significant populations with student loans? And again, remember, we may be talking about not only the younger employees just getting out of school, but also parents of graduates, both parents with college graduates as well. And so then of that population, who's not contributing to the plan, or not contributing sufficiently to receive the full match. So, is this going to enhance their retirement savings, or are we just giving them more flexibility to spend money elsewhere? I mean, I think that's a real open question. So I think digging into some of the statistics and demographics of your population to see, what those deferral percentages have been over the years would be helpful as well. And then finally, right, do the employees value other benefits over matching contributions on student loan payments? So yes, in a vacuum, standing alone, people would say, boy, this sounds like a really great idea. But again, you really need to think about benefits globally, I think, and determine whether really this is where you're going to get the most bang for your buck.
And then Ed, just to give a little flavor to that, one of the benefits consulting firms out there, a national, did a very significant survey of employees, I think it was in the tens of thousands, about what benefits employees care about. And retirement ranks very near the top, as does financial wellness, although that's somewhat of an ambiguous concept of what all that entails. And then as an extra bit of trivia, for those of you offering pet insurance, nobody cares.
Good to know, though I have some unhealthy pets, so I might value that. And also, think about what are your competitors doing, of course, right? Like if, as I mentioned to Michael, if Apple and NVIDIA are putting these programs in place to entice and attract talent, then Google may feel some pressure to do so as well from a competitive advantage, particularly in light of the tight labor market these days. But I also think too, an employer really has to focus on the cost, right? And there can be a variety of different components that go into the cost. Probably the largest one, though, is the potential addition of matching contributions on Q-slips, right? That could increase the burden of the financial burden on the employer to make those additional matching contributions. And I just put in a simple example, right? If average NHC computation is 50,000 and 100 of 500 employees who previously didn't participate submit 2% Q-slips, again, you're talking real money. It's adding an additional $100,000 in a financial obligation on the part of the employer. And so you really have to work through that. I think because it's likely to increase, right, your matching obligation because people don't have to contribute, right? There's no skin in the game at that point. They can receive match based on student loan repayments, which presumably they've been making those repayments anyhow, or will be soon. And so I think that's an important consideration. I think the other considerations are think about the potential impact on administrative costs. So plans typically pay for the record keeping expenses on a per head basis or as a percentage of plan assets, right? And so if we're bringing more heads that are into the plan that have an account balance, then we could potentially be increasing our costs. And similarly, if we're making contributions to the plan, then certainly we're increasing the assets of the plan overall. And then finally, if even though we can rely on certifications, if an employer decides to simply rely on the certification, you have to keep those, right? You have to administer that. You have to gather those. You have some time and resources invested in just running that program. Again, unless you get a third party to administer it for you, but third parties typically don't provide these kind of services for free. So there will likely be a cost to that as well. And I think the big issue right now is, can your record keeper administer matching contributions on student loan payments? We've talked about some open questions. I'm sure there are many, many other open questions that we haven't chatted about. And so, I haven't heard any that are ready to jump right into this, but again, that's my limited experience and exposure. But I think pending guidance from Treasury, I think a lot of record keepers are going to be reluctant to offer this sort of feature and may just simply not, and say they have to have guidance on certain features or certain aspects of the benefit. So I think much more to come. on this, hopefully sooner rather than later, in the form of guidance from the IRS. But time will tell. And anecdotally, I haven't had any employer come to me and say, yes, we absolutely want to do this. Some are kicking it around and are kind of looking at the guidance and looking at how this might come into play. But no one, at least of my clients, has opted to jump into this head first yet.
Yeah, and that's what I'm hearing from my clients. So, when I was talking with Secure 2.0 with them initially in January and February, like I said earlier, this is the glamorous provision. So that's all, the first thing they wanted to talk about was this provision. And they were interested in learning about it and sort of, the concluding statement like, that's interesting. But nobody really is asking me to start thinking about how to implement it. Nobody seems very eager to take this on. And I think a lot of it goes towards these open questions, the lack of guidance, record keeper resistance. Like if they're telling you that they're not going to be able to do it, you're kind of stuck there. But one of the things I'd be interested to know, Ed, from your in-house experience at, a financial services company that provided services to 401k plans, other than the lack of guidance, does this seem like a very daunting thing for the record keepers? Like, oh my gosh, this is breaking the system. We have to like totally do all kinds of new stuff? Or is it like, oh yeah, we just need to do some coding, kind of on that spectrum? Where do you think this is?
Well, I mean, I think it's standing in isolation, right? If this was the only change happening, I think, yes, there are a lot of unanswered questions, but could a record keeper put in place the ability to do this, recognizing, well, depending on who's going to be responsible for what, right? Is the employer actually going to gather all the certifications? Maybe not. So then that's an additional burden. But of course, we don't live in a vacuum, and we're not in isolation, right? And we have all sorts of other mandated provisions in Secure 2.0 and other optional provisions that people may or may not be more interested in applying. And so, boy, not a great answer to your question, but I just think, this is a lot, and it's a lot for all the record keepers I've chatted with. All of the Secure 2.0 provisions and just this wave of new coding and putting in place new procedures and administrative processes to accommodate all of these various provisions. So yeah, I think it's going to be tough to have it in place this year, but I don't know. Michael, have you heard of any record keepers that will have it in place by 2024?
I have not. Yeah. Although I think everybody's more freaking out about the Roth catch-up contributions that we covered in our first session. But
absolutely.
In our final minutes, I'll do a little lightning round with you, Ed. So if I'm an employer and I've listened to this presentation, you've convinced me that there's a student loan problem that's stressing out my employees, but that this isn't really necessarily an attractive way to do it. So I would start thinking about maybe some other alternatives. So I'm going to rapid fire throw some things out at you, and you just sort of give me a quick, what do you think about it? So the Abbott model of doing a student loan match.
Yeah, I think it's still viable, right? I think you could do it. Again, that has some complexities too. I mean, are you truly matching now? Do you fall within Secure 2.0 or do you not? And so I think employers could, but I don't know why they would do it now if they haven't done it already, right? Since 2018, because that's when the PLR came out. That's when we had a little bit of enlightenment as to the type of structure that would work and some of the issues raised. So, boy, I don't know that that's the best option, but certainly I think it's available.
Well, that certainly wasn't a quick answer.
Yeah, sorry, not much of a lightning round.
Reimbursement policy, similar to like a tuition reimbursement policy.
Yeah, again, I think those have been out there, and certainly I think it's helpful, and I think it could be beneficial to employees. But whether they're gonna, I just think there's some kind of attraction to tying this to the 401k plan, and it just seems like it gets from an optics standpoint, and that it's more impactful. That listen, as an employer, we care about not only about, your student loan debt, but also your retirement savings. And boy, being able to tie the two together and kind of sell it that way, I think is attractive to employers.
All right, well, that's 2 o'clock, so we got through 2 of my suggestions, but I have to wrap it up here so we don't keep anybody after school. Thank you for joining us today. I know there were some questions we didn't get to. We'll try and circle back with you as soon as we can. If you will get a copy of the slides and the recording, give us 1 to 2 business days for that. When you get the invite for the next session, that's where the recording and slides are. And with that, we will see you next month for session 6, where we talk about a whole handful of provisions on disclosure related to retirement plans. And we'll see you next month. Thanks.